Okay, we have a very special guest with us today, Mr. Brian Wesbury. Mr. Wesbury is Chief Economist at First Trust Portfolios, a company that we work with quite often. And again, I think you'll enjoy what he has to say. Thanks for being with us this morning, Brian.
Hey, Russ, great to be with you.
Yeah, you know, in reading some of your commentaries, and I always enjoy those, and I have great respect for what you do, and you always have a great way of boiling things down, it seems, to workable and usable information that we can use to hopefully help us make money going forward. And there's, you know, one of the things that you talk about, and I thought it was a great analogy, is about a racehorse and how our economy is a racehorse, but it has a real big jockey that's trying to get around the track, and that horse is struggling a bit because of regulation and taxes and things like that. Would you take a minute and just talk with us about that and your views on that?
Sure, absolutely. Well, thank you for enjoying that analogy, that metaphor. If you this is the way I think of it, is that we have all these great technologies. We frack wells. We have 1,000 years of natural gas now because of the invention and the innovation of fracking. We have smartphones and tablets in the cloud and apps, and we've mapped the human genome, the DNA of our bodies, and we have all these just amazing new technologies. And I look back over this last 8 years, and it's been an explosion. And I would call that a racehorse. These are thoroughbreds, if you kind of think of them that way. But the private sector, our economy, we have to pay for our government. And just so everyone knows, I'm not an anarchist. I'm not against government. It's just that when it becomes a burden on the system, when regulations start holding entrepreneurs and innovation back, when tax rates become so high that people really have a hard time investing, when government spending rises and just the size and scope of government gets so big, the private sector has to pay for all of that, has to deal with all of that. And so that's like the jockey on the horse. So a thoroughbred with a 112-pound jockey can win the Kentucky Derby. But if you have a 188-pound jockey, you can't. And I look back at the economy, as I said, in the last 7.5, 8 years, all these great technologies, but we're only growing at about 2%. In fact, the slow growth, especially in the Midwest, was one of the reasons that Donald Trump won. Jobs are harder to come by. Yes, they've been growing, but they're harder to come by. Incomes haven't been rising as rapidly as they should, and I believe it's because the racehorse is burdened by this big jockey.
So you look for pretty, I don't know how dynamic it'll be, but you feel pretty good about the stock market and the economy going forward over the next, Brian, next 4, 8, 10 years? What do you think?
Yeah, I do. There's so many things to talk about here that one thing people say is, we've had a 7.5-year bull market. It's getting old in the tooth. The recovery's been slow, like we said, but it's lasted a long time. That's getting old in the tooth. Things are going to end, and the economies don't die just of old age. So if we do have these great new technologies, that's the reason we've been growing. Actually, I look back over this past 8 years, the jockey has been heavy. What's amazing is that we've been able to grow anyway. So now, imagine what happens if we cut taxes and we slow down the addition or even roll back some regulation. If we cut the size of government, in other words, put the jockey on a diet, my belief is that we can grow faster, earnings will go up more rapidly, and that's really good for the stock market. On top of all of that, we use real broad macroeconomic models, and they tell me that today, even though the stock market's right at a record high, maybe not this moment, but has been in the last few weeks, it's still cheap. If you look at earnings and interest rates, what they say is that this market is not overvalued. In fact, it's still probably about 20% undervalued, and therefore I'm pretty bullish for the years ahead.
Boy, that's exciting. That's good to hear. Now, I'm going to shift gears on you a little bit. I was listening to an interview recently. Bill Gross talked about the 10-year Treasury, and he made a comment that I thought was interesting. And usually we don't hear guys like you sort of benchmark things, and I thought it was kind of. But he said if the 10-year Treasury yield rises above 2.6, that will signal a long-term bear market for bonds. How do you feel about it? Do you agree with that, or how do you feel about that?
Yeah, I guess Bill Gross, they call him the bond king, so I definitely would. Doesn't mean he's always right. And by the way, I'm not always right either. But I would argue that I wouldn't put it that way. If it just rises above some certain point, I do believe that we had a 35-year period going all the way back to the late 70s, early 80s. Where bonds have been in a bull market, where interest rates keep coming down, and if you buy bonds today, the value of your bond will go up over time just because interest rates keep coming down. I do believe that bull market in bonds is over. I don't need to see 2.6 or above on the 10-year. I think it already is over, and the reason I would argue that that's the case is that inflation is starting to move up, and I'm not looking for hyperinflation or ugly inflation of any kind, but inflation is moving up. Economic growth, as we've already talked about, is probably going to accelerate in the next few years, and once that move in growth and inflation starts upward, and I think we're there now, that's when bond yields start to rise as well. And to throw in there that the Federal Reserve is going to raise interest rates this year as well, 3 times, maybe 4 times.
Mm-hmm.
So I think we're going to 2.6, and Bill Gross, and we're going to go even higher on those yields. And so he's going to end up being, in a sense, right. I just wouldn't argue that it, at one particular point, when the bear market is starting.
I got you. Well, Brian, Mr. Wesbury, thanks so much for being with us. It's an honor to have you on the show today, and I appreciate you taking a little bit of time here out of your busy day, and it means a lot that you'd be on here with us. So thanks again, and we appreciate it.
You are very welcome. Thanks. Great to be with you, and stay long.
We will do. Thanks again. All right.